block of issues. The question of regulation, cybersecurity, taxation, and other related matter. Mr. Josef Mercieca, tax partner at BDO Malta.
Hi. Good afternoon. So, following from the previous presentation, I'll be dealing with two of the most boring topics when it comes to the blockchain cryptocurrency environment. I'll actually try to also deal with an even more boring topic, which is tax. What I'll be trying to do is I'm going to compare what Malta has aimed at achieving, and in my personal opinion, achieved over the last few months, and what Malta can offer to the global ecosphere in the blockchain industry. In the previous presentation, we looked at a comparison of 5 different jurisdictions. I'm going to literally latch onto that and move ahead. One particular point was that there needs to be a financial ecosphere which supports the blockchain industry. Malta does offer that. There are 2 banks in Malta, plus a multitude of PSPs, which, in addition to the banks, does provide that legal certainty which is required. What Malta has done, in addition to in comparison to other jurisdictions, is that it has moved into providing legal certainty in an area where other countries have shied away, which is taxation. Malta has a taxation model which not only encourages cryptocurrency businesses, but also provides legal certainty. But I'll come to that in the second part. So, what has Malta done? Malta has created a different asset category. Until, I would say, a few months ago, we had this ongoing debate: what are cryptocurrencies? With many jurisdictions, in my personal opinion, making a huge mistake of assuming that equity tokens, security tokens, payment tokens, and utility tokens are the same thing, and they fall within the same basket of currencies. What we've done is that we have created a financial instrument test. Latching on to MiFID II, we said, listen, are these tokens, cryptocurrencies, regulated already? Or we need to have a different asset category here. So what we do is that all these DLT assets, distributed ledger technology assets, we need to put them to this funnel of the financial instrument test, whereby we compare and analyze the exact characteristics of that instrument to establish which is the best regulatory regime applicable to that case. The first thing we ask is, do we have a virtual token, a digital medium recordation, which its use, application, and utility is exclusively restricted to being utilized on one specific DLT platform. And that particular classification would typically be yes in all cases. So what we've done is this. Listen, if I have this token, a typical utility token, which is already passing this state, this particular test, I need to give some legal certainty, some peace of mind to the investor. If you're going to list that utility token on an exchange, Binance and so on, you need to have that little peace of mind that this issuer knows what he's doing, that his white paper has been reviewed and approved by a policing agent and the regulator. So it has passed a dual fit and proper test. If you manage to pass that virtual token, we need to assess whether you are already a financial instrument in terms of MiFID. Do we have a financial instrument here? Security giving a right to a profit, rights to assets on winding up, rights to votes, to a fixed rate of return, exposure in terms of a derivative, a swap, a forward contract, a future, a contract for difference. Is this particular instrument a class of its own, electronic money? Do we have an instrument over here which binds that particular issuer to redeem at par value that particular amount deposited as electronic money? Once you manage to go through these three tests, virtual token, electronic money, and financial instrument, you end up regulated by this infamous VFA Act, the Virtual Financial Assets Act. What the Virtual Financial Assets Act creates is a special type of utility token. We have a special type of utility token which isn't a payment mechanism, which isn't a stable coin. Apart from that, as a side note, we do have ways how you could have a stable coin without triggering an electronic money license, an EMI license. We've created a specific asset category through proper structuring to avoid that. So if you manage to avoid all those classes, and you have these three characteristics, one of these three, a medium of exchange, a unit of account, or a store of value, you have a virtual financial asset. You need to go through a soft regulatory regime. But achieving a win-win situation whereby the investor is given the necessary peace of mind, whilst at the same time allowing that issuer to actually carry on the business in a business-friendly, regulated environment. In addition to that, we do have guidance from the regulators, from the tax authority when it comes to the famous three asset categories. Over here, I'm referring to them as currency tokens, equity tokens, and utility tokens. There are obviously different acronyms and different names that you could give to these tokens. I'm not going into that. So let's assume that we have an equity token, a token which is a security token, which gives a right to the assets in that company. Over here, all proceeds within that issue, so I'm raising 10 million of securitized tokens, they do not trigger a taxing event. The taxing event will never occur. In the case of payment tokens, currency tokens, again, we have an asset and a liability on our balance sheet. There are no P&L transactions, and there's not going to be any P&L transactions. Again, no taxing event. The taxing event, the taxable event occurs only in the case of utility tokens. But, there's a huge but. We're not going to tax you at the time of the ICO, unless you have an already available platform, a product which can be supplied literally there and then. What we do is this. Listen, you've collected $20 million US, which represent a future liability towards those investors. When those investors decide to cash in their token, their utility token, by purchasing goods and services on your platform, that is when the taxable event is created by shifting that deferred future liability into your income statement. So not only do we provide a deferral opportunity, in addition to that deferral opportunity, I have quite long presentation. I'm skipping a lot of slides because I got clear instructions that I can't go through all of them. What I'm going to do is I'm going to focus in the last 5 minutes of my presentation on this slide. So, ICO, deferred tax liability to the point in time where the user of that particular token, the investor, cashes in the token for the actual good or service, and then you pay tax. Generally, typically from our experience, 2-3 years down the line after the ICO if the project is successful. At that point in time, the Maltese company over here, the issuer, would have a fictitious income of 100 euros, on which there is a tax due of 35. But upon a dividend distribution from that Maltese company to the foreign shareholder, or to a holding company in Malta, that shareholder becomes entitled to a tax refund under the full imputation system. Malta is the only European country which has a full imputation system, whereby the tax paid at the company level in reality is a prepayment of the tax due by the shareholder. When that shareholder receives a dividend, he is always entitled to a tax refund. And that tax refund depends on the type of income and the classification of the particular shareholder. In many cases, for ICOs, at least all the cases I have encountered in these last years, they would be entitled to a 6/7 refund. So you have a tax payment of 35. Within a couple of weeks, our tax authorities will give you back 30. And in your pockets, you end up with 65 as the net dividend, 30 tax refund. That's 90 euros, 95 euros. So effectively, on the whole income of that particular structure, we've generated a net cash flow in our pockets of 95 euros. Effective tax leakage, 5%. Again, this particular model could be complicated a bit and worked upon from a tax structuring point of view by creating a dividend feeder company over there. The dividend feeder over there is used in certain cases in order to avoid very aggressive anti-tax avoidance provisions in other jurisdictions. So, let me conclude by looking at a particular aspect of our taxation which is typically not common in other jurisdictions. And this is what happens in the case of disposals of cryptocurrencies. Disposals of cryptocurrencies are classified into two categories. Those which are of a long-term nature, so I'm a hodler, versus those which are traders. Traders, on those profits, pay taxes at the normal rates. In the case of hodlers, those which hold the asset and eventually make a capital gain, that capital gain is taxable only in the case of security tokens. If that particular token isn't a security token, it doesn't fall within the definition of taxable assets within our Income Tax Act. So again, Malta tends to be a very, very attractive jurisdiction for Bitcoin holders, cryptocurrency holders, which are considering disposing of their long-term holding because we can provide an environment where that significant capital gain can be received in your pockets, net of any tax. There is no tax leakage on that. It is outside the scope of tax. Thank you for your attention.